Phil, thrilled to have you back at the NYC. Thanks so much for joining me as usual.
Thank you for having me.
So the Fed's meeting kicks off today as this episode comes out, and it's one that investors have obviously been watching closely, one that's highly anticipated, with markets widely expecting a rate cut. It would be the first time in a long time after obviously rates have been held steady for a while. Just what are you first and foremost expecting from this meeting? How pivotal just is this moment, and what does it reveal about the Fed's current outlook on the economy?
Yeah, those are great questions. And really what we've been looking at for months now has been a expectation for 25 basis points of cuts today. And my read on the last week of economic data is that the case is building for a 50 basis point cut, and markets seem to sort of agree with that. I think we've seen bets for a 50 basis point cut increase to 10% in the last few days. And that comes from weakening labor market data, pretty unconcerning inflation data, I would say. And that combination confirms the Jackson Hole speech from Powell a few weeks back when he essentially waved the white flag on inflation and said, look, the risks lie in the labor market now, and we're pretty much going to let inflation do whatever inflation does. And, he didn't say that in as many words, but that was the messaging or the takeaway that I read in it. And the big headline last week, we had almost 1 million jobs wiped out from the BLS revision in the 12 months to March. So that, to me, all the concerns that the labor market was weak, it turns out it was way weaker than anyone even knew or thought. So all of this is pointing to, I think, a bigger cut than we're going to get. But the Fed is probably going to take its time and go forward with a 25 basis point cut.
So as Chair Powell steps to the mic, because obviously everyone's anticipating whether it's going to be 25 or 50, but equally as interesting will be what Powell says after the fact once that cut is announced. So as he steps to the mic, what will you be listening for in his press conference that might signal whether this rate cut is the start of sort of a broader shift or just sort of a cautious adjustment? If the Fed does move forward with the cut, which again is expected, what do you think he might come out and say about what's next?
Yeah, we're going to be looking for whether Powell signals that we're getting a series of cuts, right? Or if it's going to be sort of a hedge and say, look, we're going to make a move today and then we'll see what happens. And, he's very careful with his language always. He always says we're going to remain data dependent and go case by case. We're not projecting out months in advance because really the Fed is not meant to be forecasting. So that was a big criticism of this year, I think, of monetary policy. They were trying to project the impact of tariffs on the economy. So they were holding back on cuts because they thought tariffs would be inflationary. And we've seen mixed results on that forecast. But I expect Powell to keep his careful tone as he always does. And he's probably going to say, look, we're not going to talk about the future, but the data today is telling us we're going to make a cut. And again, my team at Opening Bell Daily, we've been pretty much calling for cuts since March, and the Fed has not done that, obviously, and we're going to see a move. But the Fed has been, I think, each month of economic data has confirmed that the Fed has been delayed in their reaction. And I think there is some question of Fed credibility these days because you have Powell, who's on his way out, right? And you have the Fed independence question with President Trump. But then really you have this delayed reaction, and the institution itself is a backward-looking institution, right? So they're structurally limited in what they're able to do. But I do think they've been so late this year that we will have trouble believing them or taking their judgment for better or for worse in the coming months.
And so you said you and your team at Opening Bell Daily have been calling for rate cuts since March. So if Powell and the Fed are indeed now behind the curve when it comes to cutting rates, what do you think are potential risks or consequences of their delay?
The biggest risk, and Powell has essentially said this himself, is the labor market, right? So we have jobs are not growing as we thought they were, and we also had way fewer jobs last year than we thought we did. So that is given the Fed their reasoning to let inflation do whatever inflation does. So that signal in Jackson Hole saying we are fully focused on the labor market, the quote balance of risks has shifted. That to me is spot on, and the Fed knows it. Everyone knows it. If you ask any of your friends that are hiring managers in engineering or AI or tech, no one can get jobs, no one's hiring, and that to me is not something that is so easily fixable, let's say. And if inflation does run hot, I think the Fed can always pause or adjust interest rates, right? Fixing a broken labor market or one that is slowed so severely, that is a much harder task.
So you mentioned the labor market, and earlier in our conversation, you talked about the almost 1 million jobs, that downward revision. I think the number exactly was, I think, 911,000 for the 12 months ending in March 2025. Now, we've seen up until that obviously that big one, we've seen several job revisions recently, none obviously as dramatic as that 911,000. Yet despite these negative adjustments, markets really haven't flinched all too much. Why do you think investors are largely sort of shrugging off this data?
So part of it, I think it's in line with expectations that the Fed is going to be lowering interest rates. So a massive jobs revision doesn't change that narrative whatsoever. It's the Fed is going to move forward. We're going to get lower borrowing costs and asset prices can go higher, maybe because of that alone. However, we have also had in recent weeks, analysts are already raising their fourth quarter estimates for earnings. So earnings are driving this market in a very positive way. And you still have the AI momentum, which is going. So between the rate cut expectations, which are getting essentially even more deeply confirmed with the job data, and then you have strong earnings and rising expectations for those earnings, the momentum is very clear. And I think the lower interest rates, that should help small caps, tech, housing, right? So all these things are going to loosen up in theory in the coming weeks and months.
So we talked about earlier how the long time expectation was that it would be sort of a 25 basis point cut. Now, with these numbers coming out, it seems like it could possibly go to 50. Obviously, we'll wait and see what Chair Powell has to say, but 50 is sort of not
Not the base
off the
case.
table. Yeah, it's not off the table,
Yep.
so to speak. And if we keep seeing these big job revisions, these big downward job revisions, if we keep seeing layoffs continue to rise in the coming months, do you think that puts more pressure on Powell and the Fed as a whole to, in meetings to come, have deeper and more aggressive rate cuts than maybe expected before all these downward revisions?
I would say the pressure has been very high on Powell already, politically, but also from the data, right? So you have pressure from the White House that the Fed should have been cutting, and you've had economists calling for the Fed to be cutting, and then you have the data, I think, screaming for Fed cuts. But none of that is probably going to accelerate the pace of cuts based on what you can, they're going to be a slow moving incremental institution, and that is just what they do. So I don't expect all this external pressure to really, let's say, increase the pace of cuts. And even Jerome Powell's successor, I don't think he's going to come in and cut interest rates by 300 basis points in one go. That's just not what the job is. And even if President Trump is calling for very deep rate cuts, it's still going to take incremental a sequence of events, right? So I wouldn't say that all of this combines to a faster pace of cuts as much as maybe the president or even some people looking for jobs, as much as they may want that. I don't think we're going to see that.
So, Phil, in the short term, a rate cut will offer some relief, but what about longer term implications? Do you see this move sort of paving the way for more sustainable economic growth, or could it risk reigniting those inflation pressures that the Fed has spent now years really trying to contain?
Yeah, inflation is certainly a risk, I would say. And again, the job market is the bigger risk. And I think you could say it's a near-term and a long-term risk, because if unemployment starts rising, it can be really hard to get out of that rut. And inflation, look, it's been rising dramatically for the last 5 years. So that is something that I don't think we can say the Fed has been successful at taming anyway. So if we say suddenly, okay, they're going to focus on inflation and try to get it under control, well, we've lost 30% of our purchasing power in the past 5 years. So this to me is a little bit of too little, too late, right? And the risk now is in the job market. So and the Fed sees that as well. So I'm not alone in saying that that's where the risk is. Inflation, it's unfortunately, I think that it's part of the present economy, and I don't know how we can really shake out of it. We also don't know the long-term effects of tariffs, right? Yep. So that's another variable that we're just not sure what's going to happen. So there's a lot of unknowns right now, but the balance of risk, as Powell says, is certainly with jobs.
Well, Phil, I appreciate you always joining me here at the NYSE. I look forward to our conversation next month and in the months to come.
Thank you for having me.